Thank you very much for joining us on Sunday morning. We will take you through the decree law that is released on corporate taxes, as well as they have released a few more ministerial decisions after the decree law. So we will also be covering those ministerial decisions as part of our presentation. Please keep a note of the important thing that there are more decree laws that are expected or ministerial decisions that are expected to come out. The couple of the important areas are like the definition with respect to the qualifying income, which is related to the free zone taxation, the important one, and also the taxation with respect to the business income earned by the individuals. So these are the two areas where the further rules are expected to come out. And of course, there are a few more to come out, but yeah, these are the main important areas where we are expecting the ministerial decisions to be released. I think they should be released before this 31st May. Okay, so this being the background, so I would like to invite my colleague Manish Shroff to take the presentation forward. Manish?
Good morning, everyone. Uh, uh, Thank you all again, to be part of this session today, being early in the morning and bright Sunday morning. So I think we are good to go. As you all have already heard about it, maybe some provisions you would have read through. So the purpose of the session is that we will deliberate on each of those topics, and once we have run through this, then we will get your questions and try to address in specific business scenarios any queries which you have. We will run through that. So, in terms of the areas we're going to cover about is, why this corporate tax has come in UAE, and what are the different persons covered under this corporate tax, and what are the tax base, because and on what amount, the taxation will be calculated, and then the different free zones, how what is applicability to them, then the losses, how it can be carried forward, and grouping of different entities. Then you may have a withholding tax, which is basically of, but we will talk about how we deduct, like we have a tax collection at source in India or tax deduction at source. So those points we will cover. Then related connected persons, we will define what are those transactions and what are those definitions under that, under the corporate tax, and then the transfer pricing applicable to those related persons. And then the administrative activities in terms of filing procedures of returns and registrations. So in terms of the background, over last 5 years, you would have seen that a lot of compliances in UAE has increased. It's basically the whole objective of bringing in more compliance is for the government to bring in transparency in the business in UAE. Though we have more and more investors, and among other countries, we are seeing that we are not just avoiding tax, but uh, providing a free, investment opportunities, and it brings in par with other countries. So the first thing is country by country reporting. It is for large multinational enterprise with a higher threshold, which is more than 3 billion dirham of revenue. The higher, and those have multi locations and multi countries. For them, that is applicable. And economic substance regulation is majorly for the companies in free zone and specific business activities. They need to prove their substance in UAE, so this reporting is required. And value added tax, you all have heard about it, and you would be complying to that, which is on your sales, which being applied. And then anti money laundering is compliances for counterfeiting, terrorism activities, and the source of income, and mostly applying to the brokers, to the jewelry businesses, which are for the customers. KYC compliances we need to be followed in UAE. And then finally, we have the corporate tax, where it is recently being introduced, and we will see why it got introduced. Now, the whole purpose of bringing in corporate tax is to bring in transparency. UAE earlier was considered to be a tax haven, tax-free country, where people may not have actually operating the business physically in UAE, they would be operating outside the UAE, maybe in India and any other part of the world, just for saving the tax. They have their operations in terms of sales, billing happening here, but then physically they may not be. But to avoid that, the corporate tax has been introduced, and it helps in development overall. And because the more and more investors and transparency will bring in more business to this regime. Yeah, next slide. So in terms of until now, and what has been, what is the status in terms of the corporate tax journey? In 31st January last year, the public consultation document was released where they mentioned, what are the different provisions which would be introduced in the corporate tax. And then finally they had a federal decree law, which is the corporate tax law, in December now last year. And then they also mentioned about the frequently asked questions, that different business scenarios deliberated on that. And then over the last, I mean, from last 3 months and recently last 2 weeks, we have been cabinet resolutions, big, which basically gives more and more clarity on different provisions in the decree law. And we will definitely have more such, ministry decision coming in. So in terms of the implementation date, it is for a period of 12 months, tax financial year, which you have to look at in memorandum of your companies, which will mention that what is the tax period you have to look at. And it is starting from this corporate tax is getting implemented from 1st June 2023. So any companies which has a tax year from June onwards. So if someone has from 1st July to 30th June, so for them the first year is 1st July 23 to 30th June. And then there is a period of 9 months after the end of those tax period where they need to file their return. So for like the one which is July to June, the first tax period filing will be happening on 31st March, and subsequently for October to September. So any period starting from June onwards, and most of them would fall under January to December. So this would be applied next year. So 1st January 24 to December 24. And then the 9 months after the end of December 24 is September 30th, by which you need to file your return and pay the tax. Now, recently, this is a new amendment, new decision, cabinet ministry decision came in, which allows to change your tax period. So the first you need to look at a memorandum. What is the tax period defined in that, which is generally a 12 months period. And if you want to change, there are certain reasons for which you need to consider. If a company is getting liquidated, then you want to change the layer. That means if someone is getting, if a company want to liquidate in the mid of the year, so they want to liquidate in say June 24. So the tax period will be for that financial year from 1st June to 30th June, or whatever the tax period they have mentioned in a memorandum. But the date of the closing date of that year will be the date when they are liquidating. And then it could be aligning with the tax group. Just go back there. And then you need to align. The purpose of this could be aligning with the tax group. There are multiple holding companies, and then maybe the holding company has a different tax period, and then the domestic company has a different tax period. So to maybe it is following, maybe if it is in India, it is following 1st April to 30th March. And if you want to align to that, then you may change and apply for the changing the tax period. And then it to be valid commercial and economic legal reasons, in terms of you want to align with your business operations for with the different group companies. And it can be extended first year, like if it's starting from 1st January to 30th March, I mean 1st January to December next year. And maybe you want to change the tax period. It can go, the first period can be up to 18 months, because you want to align. Maybe you're until now you have been following maybe April to March, but you want to align to that period. It can go beyond, I mean, 12 months period, 18 months, and it cannot be less than 6 months period. So it can be shortened up to 6 to 12 months to align to the tax period. And the timeline when you can apply for change is within the 6 months. So if your period is closing on December 30th, 2024, then within 6 months, which is I mean, because there is a time period of filing the tax return up to 9 months. So before the tax filing, you need to do this return. I mean, the changing the your financial tax period. Now, the persons can be classified into judicial and natural person. The judicial person are the persons who are basically your LLC companies, the registered legal entities companies, which are separate from the individual and private joint stock companies. Whereas natural person are the individuals who are running their own business in terms of freelancers and individual consultancy, sole proprietorship, and it could be further categorized as exempt person or taxable person. So we look into the what are those exempt person and taxable person. And in the UAE, if you see the geographical form is we have mainland and free zones. There are 44 free zones in UAE, and then those are classified. Some of them are specific free zones like DMCC, financial free zone, and others free zone. And then offshore companies, they all fall under the UAE corporate structure. And then the legal forms, it could be in different form, like as I mentioned, that it could be limited liability company, public shareholding. These all which are highlighted in white color are the judicial person, and then the civil company partnership. These are the individual who are running their own business. Okay, so the tax rate which is applicable in general would be there is a threshold limit beyond which your income will be taxable in the business. So up to 375,000, it is 0%. So when you earn your income up to 375,000 dirham, it is 0%. But beyond that, it would be 9%. But now for the free zone companies, it has been further classified as qualifying income and non-qualifying income. So the qualifying income definition, we will look into it. Balram will define, and cabinet will further also add on to this clarifications. So qualifying income is 0%, and non-qualifying income was is now 9%. So those, they don't have a slab limit here. For the free zone company who fall under the non-qualifying, will be paying 9% straight away. I mean, there is no slab for that. Exempt persons are under this four categories which have been defined, which first is like automatically exempted. These are the government entities, government control entities like RTA, Ministry of Human Resource. These are all government, and they are serving for the public. So they won't collect tax from they won't be paying tax on the government, on the public funds. And then next is they need to notify to the Ministry of Finance extractive business, which are natural resources like oil and gas extraction, and non-extractive natural resources are the who are doing the refining process, processing those natural resources. Those are also under the exempt category, but they need to apply specifically to FTA to get that exemptions. And these are already covered under Emirat tax, so they are paying separately. Different Emirates has a separate tax, so they are paying under that. So that's why they are not covered under corporate tax. And certain exemptions which can given to the qualifying public entity benefit entities, those are like charitable institution, non non-profit organizations, because they are not making commercial money. They are not benefiting, they're not making profit, they're just serving the community. So that's the reason they are exempted. And time to time ministries are going to declare the list, and recently they declared the list of qualifying public benefit entities which are listed on that would get exempted. And then exempt if application is for submitted to FTA for a specific public pension fund, private pension, social security. Those are the funds which are for the benefits of a specific citizen or specific purpose, and that's the reason they get exempted. And qualifying investment funds are generally the funds which are being traded in the stock exchange. They're already regulated, and these are the funds being invested for other different companies. So the fund itself doesn't fall under the corporate tax; they are exempted. And then definitely the entities which are fully owned and controlled by government entities, government control entities, pension funds. So those which are already exempt and they are controlling particular entities, and that is supporting in their businesses, in the government entities for activities, they also get exempted. And the exemption benefit is in terms of filing procedures and documentation. Now, the registration requirement. So the first benefit they get is exceptions from the registration. They don't have to apply for corporate tax registration. So these are out of those categories which we discussed about exempt persons. These are the three categories of persons, which are given exceptions from registration. They don't have to apply for registration, which is government entity and government control entity, and that this person engage in extractive business and non-extractive natural resource business. And then the third category, which is though they are not exempted from corporate tax, but then they are under the exception of from the registration. A non-resident person deriving UAE source income does not have a permanent establishment. We will look at it. What is permanent establishment in the subsequent slide? But then, if you talk about if you see example about a non-resident person, that an Indian company who's investing in, who's generating income from UAE. Suppose they have a customer who they are dealing in UAE, but they are not having any kind of offices or any, presence directly in UAE, but they're earning from that. So though it will be taxable, but it is exempted, that non-resident is exempted from registration. So now there are timeline for registration, and this timeline is applicable for for the person who are exempted. Now, we already saw that there were three categories people, persons who are exempted from registration. But now, even those people who are exempted persons, like qualifying public benefit entity, they need to get themselves registered by those are like non-profit organization or charitable institutions. They need to register by 1st October 23. And then the other category, qualifying investment fund, they and public-private social security fund, and those entities wholly owned and controlled by exempt persons, they need to register by 1st June 24. These three category, qualifying investment fund, public private fund, and entities wholly owned and controlled by exempt person, after applying for registration, they need to apply for exemption. They don't by default get exempted from corporate tax. So within 60 business days from the end of the tax period. So if the tax period is ending in December, so within by Feb, and they need to apply for exemptions. And all other category which are not exempted, they can apply for registration before the filing of their first return. So 9 months after the end of the financial tax period, they can apply. So if the tax period is ending in December, so 24, then they can apply by September 25 for the registration of corporate tax. But before we apply for corporate tax registration, we need to look at different parameters in terms of you need to form a group company because you have different state licenses and different businesses. So whether you need to club as a single tax group or not to form a tax group, those aspects need to be assessed before applying for corporate tax registration. Then after you would have registered, and then there are certain scenarios where you need to deregister, need to apply for deregistration of corporate tax. Natural person whose business gets, whose business activities are no more continued. So within 3 months from the date of business activities not being continued, they need to apply for deregistration. And then the entities who are registered judicial person, they need to apply from 3 months from the date the business resolution or liquidation happens. So if the liquidation happens in June 24, so within 3 months they need to apply from thereafter to deregister the corporate tax. Now, this is a summary in terms of who are taxable persons. So, taxable person for majorly categorized as resident person and non-resident person. So, resident person, within the resident person, the first category it is who are incorporated, in UAE, LLC companies, private stock companies. Those are who are registered in UAE. And so, yeah, within UAE, which are incorporated and registered, could be either in mainland or it could be free zone. So these mainland and free zone companies are covered under the corporate tax. But yes, under the free zone, it is further classified as qualifying income and non-qualifying income, which we will look at later. But then they need to be registered under the corporate tax. And those entities which are incorporated outside UAE but controlled and managed in UAE. Now, some of the companies which are basically maybe in the BVI, British Virgin Island, or in some other part of the world, but they are controlled and managed in UAE because the decision making is happening in UAE. So they are fall, or they also fall under the taxable category of corporate tax. Then natural person as an individual who are running their own freelancing business or consultancy, those also, and here the natural person is like, thankfully salary income of that natural person is not covered under this, but the one who is actually doing a business activity, which if he would have formed a business, his own legal entity would have done the same activity, if taxable, then that in individual capacity as well, that business becomes taxable. Another person which time to time ministry will come out and include under the taxable category. And non-resident person, the important definition is on the permanent establishment. Either it could be having a permanent establishment in UAE or deriving a UAE source income, and then could be having a nexus in UAE. So permanent establishment, we look at the definitions the next slide, but it has the one which has a I mean, they're having a branch office, they have a office set up, factory, any operations being carried out with a fixed permanent location here in UAE. Deriving UAE source income, that is the customer base is in UAE, and having nexus in UAE is somewhere that source of income is related to the business in UAE. And to look at one more point is the branch, a branch of any trade license covered under the business. If they have a branch, suppose there is a mainland company in Sharjah, and then they have a branch in Davza. So then the Davza branch would be falling under the Sharjah branch, Sharjah mainland, and then there will be common tax registration. There will not be separate tax registration for the branch. Now, for the tax base, if you look at it, is either a judicial person or a natural judicial, which is registered and a separate identity from the legal entity. Deriving income from UAE, of course, whatever income they are earning based on the business, either they are into trading business or governments or any kind of business into manufacturing or trading, or what kind of business they are into, and they are earning income from the customer base in UAE, so they are subject to tax. And then the another point is income derived from the rest of the world. So a legal entity, an LLC company who is set up in UAE, but they are serving, or they have a customer base maybe in Europe, or they have a customer base in Oman, uh, Bahrain, anywhere, outside even in UAE. But the most important point is effectively manage and control. So the decision making of selling or serving outside UAE is taken from UAE. So the income earned from those countries, where the customer base is, they would be still taxed in UAE. But then we look at other provisions at that if there is a tax they have already paid, or there is a treaty with UAE and other country, then that tax treaty also being considered to take a credit of those tax paid outside UAE. Then the natural person income derived from UAE, of course, like, as a consultant who is serving in UAE and he doesn't form a legal entity, maybe a consultant doing, advisory services in UAE from a customer base in UAE, and also income derived from rest of the world. So now, because of the remote working, you can have a client base in Europe sitting in UAE, serving them, then that also can be taxable. It is insofar it relates to the business activity conducted by natural person in UAE. So sitting out of UAE or serving Europe customers, you can be still taxable under advisory or other individual capacity business. Yeah, the next slide. Now, when we look at non-resident, we talk about the different three categories under which a non-resident income will be taxable. So the income which is sourced and income sourced not attributable to PEE of NR. So now, what does it mean? Basically, you have earning in UAE, but you don't have any presence in terms of offices, but your customers are in UAE. So someone from India is supplying goods or materials to UAE customer, then that income which is earning from that would be taxable from UAE, but doesn't have any physical presence. Then and it is derived from the resident person. So that means his earning is from the person who's The customer is a resident in UAE. Then income attributable to PE of non-resident in UAE. Now, it is basically income which is attributable to the PE. PE basically we'll look at definition next slide, which talks about having a permanent establishment and offices, a factory, any income generated from that fixed location, fixed operations in UAE, that tax. And then the income which is attributable to the nexus, with somewhere the relation is there with the UAE customer or the income, that also get covered, and that nexus yet to be further clarified by the ministry. And then the source of income derived from the resident person, then derived from another category which is mentioned in the source income from not attributable to PE is derived from another non-resident. That means if entity A which has which doesn't have a physical presence in UAE, but there is another in non-resident B and having a permanent establishment. That means they have an office, a branch in UAE. So A applying servicing to even B, who is a non-resident but having a permanent establishment and from a branch or in kind of setup in UAE. So other than resident person, even non-resident earning from second non-resident person in UAE through their PE, through their branch office, they can still be taxable. And then income from activity performed in UAE from different natures. Now, this is the main, if you look at what I was mentioning in P, determining the P. Now, non-resident person has a fixed permanent place in UAE. So in terms of having a branch office or any kind of setup in UAE or factory, any kind of form of setup in UAE will be a fixed location for them. Yeah. So the next test is non-resident has a habitual exercise authority through another person. Now there is an agent on behalf of a non-resident in UAE. So maybe someone who's supplying garments, and there is an agent who's helping him to get the customers and whether to sell particular customer or not. That non-resident sitting out of India is making a decision and telling that agent in who is resident in UAE to sell this particular customers. So the decision making is done by the non-resident, and his that agent is just following the decision which from in UAE on behalf of the non-resident. And then another is a non-resident has any other nexus that cabinet will further clarify that what are those conditions under which then the non-resident will have an access in UAE. Yeah, next slide. Yeah, so now no, when we talk about the test two, which talks about having a dependent agent and independent agent. Now as I mentioned, that a non-resident who's selling the garments in UAE through an agent based out of UAE, a non-resident who has from India is supplying the garments to UAE, and then the agent who's following the instructions of the non-resident, then it will be subject to taxability of corporate tax. The non-resident will be subject to the corporate tax. Now, in case an independent agent is there, an independent agent who's working for different companies, who's taking his own decision, he's a broker, and he's getting the clients and helping or selling or servicing the non-resident, I mean, he's serving A, B, C, D. There are different non-residents. One could be in UAE, in India, another could be in Europe, or another could be in Bahrain, Oman, anywhere. And that agent X who's serving different non-resident, then that those who are serving as independent to multiple clients in UAE, then the independent agent will be considered, who will be taxable. So the non-resident will not, the not considering non-resident will not be having PE in UAE, and NR will not be subject to the corporate tax. The independent agent will be subject to corporate tax. Now, if you look at the key takeaways, is the legal structure we need to know in terms of whether it is a judicial person or a natural person, and how they are structured, how how whether they're outside UAE or the entities are located in the UAE, and whether they have a foreign branch. I mean, the foreign branch, which is basically, and UAE can have a foreign branch outside UAE, and even like I mean, companies based in India, if they have a branch in UAE, how that tax structure will look into, whether they need to have a PE or without a PE, they need to uh, operate the business. And then which are exempted categories, we need to see that, if they are government controlled or business into natural resources or other public benefit entities. And then, and in terms of fixing the financial year, the tax period, it is generally mentioned in the memorandum. If you don't have that clarity, then, you need to consult and see what tax period you need to define. And there is a provision now that you can change your tax period. Now, the exempted income, what are the incomes? We have seen that there are exempted persons. Now, the income which are exempted. So, dividend and other profit distribution received from a judicial person. Now, dividend and other profit distribution, because dividend and profit distribution is already taxed in the legal entity. If an LLC company, is distributing a dividend to his shareholders, investors, then that is the income is already taxed. So dividend and profit is not being taxed to the person who's receiving that, resident person who's receiving that income. And then income of a foreign permanent establishment, then a company who is based out of UAE and having a permanent establishment out of UAE, then he can opt for not paying the corporate tax, provided the corporate tax should be more than 9%. If in India it is generally 20% plus, then it might then he can apply for exemption for the tax earned in the income earned in India or any other country. Income derived by non-resident person from operating aircraft, ships. These are basically international routing, so they don't fall under the mainland or free zone. They're specifically international businesses, which doesn't fall under the exempted in the corporate tax. And then participating interest, both from resident and non-resident. So there are certain categories. If you are investing and business by your investment should be more than 5%, and then you should be holding that investment more than 12 months time. Then those can be exempted. And then the gain and losses, capital gain losses, foreign exchange impairment losses. These are basically also exempted from the corporate tax. Then dividend and profit distribution from participating interest. So whatever you have invested in any other company, maybe a person in sitting out of in UAE and invested in India, and then he's holding that in more than 5%, and then the dividend earned on those, because that particular location or country would be paying tax, so they would not be paying on dividend and profit distributions. Yeah, next slide. Now there are different deductions, as an expenditure which you can claim from your revenue. What are the deductible items which are there to derive at your taxable income. Now, the first thing is that the deduction is in the tax period in which it is incurred. Now, it is deductible. That means your financial years is starting from 1st January. Someone who's having a tax financial year from January to December, for them it would be applicable. The corporate tax would be applicable from 1st January 2024 to 31st December 24. So any expenditure which has been incurred in that period can be claimed. It is not that he can claim an expenditure incurred in 23 and 24. It is only in that tax period from which the corporate tax is applicable. You can claim that. Then it is not related to the exempted income. Uh, then it is basically it should not be related to the exempted income, where you have already exempt, like dividend, profits. Any expenditure incurred on that will not be deductible. Then certain decisions, which expenditures may be specified in the decision by the cabinet, time to time they will come out. Then not in capital nature. So not in capital nature. Just back to the slide. Just I was on the reverse side. So not in the capital nature. Basically, it is expenditure. You bought an asset, okay, and when you bought a machinery or you bought a car. So you cannot claim payment made for buying that car or an asset, because you are going to claim a depreciation expenditure. So those items which are in asset in nature, you cannot claim that amount, but the depreciation can be claimed as an expenditure. And the most important thing is incurred wholly and exclusively for the business. Now that means that expenditure should be incurred for carrying out your business. Maybe you have a telephone and a mobile connection, and you are making your personal use and the business use. So the whole amount of the payment which you are making for the monthly expenditure of maybe 500 dirham you have as a telephone bill as an individual, you cannot claim the full amount. You need to bifurcate. You may need to allocate that. Maybe 60% are going to allocate for the business use and 40% for personal use. So that has to be allocated. Similarly, your fuel expenditure for day-to-day car running, it's not completely being used for the business purpose. So you need to allocate between your business and the personal. And another part is also something which is related to as a individual who is also an owner to the company. He is serving in the company, and he until now you may not be drawing as a salary. So the salary income, you need to show from 23 itself, which you can claim as an expenditure. But now the question is, what amount of salary you can claim from the business? That need to be looked into. There comes into transfer pricing, connected person the relationship with the business. So what amount we need to show, that based on the market and then the business size, which we need to review and assess the amount we can claim. We cannot just straight away claim 50,000, 60,000. That need to be assessed before claiming as a salary income. Now, certain expenditure which are not deductible, expenditure related to exempt income, that is basically not, you cannot claim that. Another point is, interesting point is, interest beyond 30% of earning before interest tax deduction, depreciation allowances. Now this is capped. If you have, suppose you have a loan from the bank, and you have been paying, suppose the interest amount is 100,000 in a year, and then that amount has to be considered limited to your earning before interest and tax. That we will look into next slide, how that calculation is being done. Then related party loans. So now related party loans is basically the purpose, interest on related party loans. Like, if you are an owner and you are funding the business, or your family members is funding the business as they are related party, then that need to be looked into. The deductibility, the interest amount cannot be claimed without a substance. Without substance means if you are may- giving a loan to the company, and for drawing the profit, for payment of the profit or payment of the dividend, just for that purpose, then that interest amount will not be allowed as a deduction, because that is not for the whole commercial purpose. It is just for making a payment to yourself as a profit or dividend. That loan cannot be allowed. Interest on the loan cannot be allowed. Then the another cap is 50% of entertainment expenditure. That means if you are doing an expenditure for entertaining your client, in terms of taking out dinner for lunch to your clients, or giving any kind of movie tickets or any kind of entertainment expenditure for your customers, your clients, uh, or your business partners, then that is not allowed. But here the another question comes in: will your entertainment expenditure for your employees, will it be allowed? That, and since in the ministry decree it is not yet clarified whether the expenditure pertaining to your employees, like if you're having a team gathering or team meal for your employees, will it be? Yes, ideally it should be allowed, because that is for your employees. That is, they, as you are paying salary, so any expenditure incurred for your employees also becomes eligible to be claimed as 100%. Then non-business expenditures, yes, anything which is in personal nature, which is not for the business, that becomes non-deductible. So you need to look at the chart of accounts. Expenditure, generally people would claim any kind of, for your school fees of the your children's, if you're claiming as an expenditure booking until now. But then you need to consider that to what extent you can claim those expenditure for which is incurred for your children's school fees, or whatever personal nature, or personal telephone bills. Everything cannot be claimed now, which is not relating to the business. And any fines, penalties, of course, that you have defaulted, and if you are trying to claim, you cannot claim that. And capital expenditures cannot be claimed, because these are allowed as your depreciation. Now, interest expenditure, as I was mentioning, it is the limit here is up to 30% of earning before interest, tax, and depreciation allowances. Now, net interest expenditure, that means if you have an interest income, suppose if you have an interest income of 50,000, and you have interest payment on the loans of 100,000, so the net amount becomes 50,000. So up to 50,000 only you can claim as your business expenditure. But then you need to look at that what is your earning before interest and taxes. So if you have a earning of suppose 1 million, so 1 million is an EBITDA, and 30% is 300,000. So up to 300,000, you can claim your net interest expenditure, which is 50,000 in this case. But in case if it is less than that, if your income is suppose 100,000, and 100,000 is your EBITDA, and your net interest expenditure was 50,000, so only up to 50,000 you can claim that amount as a net interest deductible expenditure. But then there is another provision by which you can carry forward this unclaimed portion of interest expenditure up to 10 years. So that can be allowed, next subsequent years you can carry forward and claim that as an expenditure. But this deduction applicable is not applicable to the banks and different business entities. Now, entertainment expenditure, as you mentioned, about 50% deductible rule, it is to the customers, shareholders, suppliers, business partners. These are just for getting the business. This generally we entertain our clients or customers to get more business. So to limit that activities, the government has limited that. You can only claim up to 50% if you are, incurring any kind of entertainment expenditure in terms of meals, accommodations, any admission, transportation, supporting them, that is limited to 50%. But now in related to employees, these, since the ministry decree has not clarified in that, so we assume it can be 100%. So other non-deductible expenses are, it is, if you look at it, is tax on income imposed on the taxable person outside. So and the tax you are paying, tax is cannot be claimed as an expenditure. And similarly, the corporate tax paid is not a deductible expenditure. And dividend and profit, which is distributed by the company to its shareholders, is not an expenditure. It is after the profit, after the profit you are distributing that. So that cannot be claimed as an expenditure. Then amounts withdrawn from the business by a natural person. So the person who's withdrawing amount, generally we withdraw through a current account, and that is that withdrawal of amount is not, it's just a reduction in capital, or maybe out of profit distribution you withdraw that amount. So that is not an expenditure. And any kind of bribes, definitely if you are paying bribes, it is not, it's an illegal activity. And then another point is input value added tax claimed. Value added tax, you adjust it. It's something which is recoverable value added tax, you can claim, I mean, which is recovered from your output tax, you adjust that. But something which you have not adjusted and still can be claimed, suppose generally what we do is small amount of taxes, say suppose for telephone bills, we have, you maybe 100 amount is 100 is amount, and 5 is that your VAT amount on that. But generally for small amount we don't track that, and we, so those amount of VAT which we could have claimed from the VAT output, and if you are not keeping a track, and then those expenditures you cannot be deducted. So from now onwards we need to keep a separate track of those even small amount of value added input tax to be adjusted from your output. If you don't claim from your output, then we cannot be claiming as an expenditure. Then the donations, grants, or gifts to any qualifying public entities. Now, now this is any grants or gifts which is given other than the qualifying public benefit, and the qualifying benefit entity list is time to time will be declared by the ministry. And if we are giving donations to those qualifying public benefit entity, then we can claim. But then other than that, any gifts, donations, which are not covered under the benefit public benefit entity, they cannot be claimed as a deduction. And then of course the fines and penalties which we pay, due to default, we cannot be like any VAT penalty which we are paying cannot be claimed. But then there is like an other than the compensation for damages of breach of contract. Suppose if you have a contract with your client to deliver certain services or goods within specific time limit, and if you cannot deliver, then there is a penalty for breach of that contract. Then those penalty is basically part of the business. You got delayed and there is a penalty of 1% or 2% of the amount you have to pay because there was a delay in delivering the services. That can be claimed because that is not actually of, I mean, imposed due to the business's intention to to pay fines or penalties. So that can be claimed. But then the normal fines, penalties for RTAs or any other thing can not be claimed. So the key points to be looked into for deductible, non-deductible expenditure is to see, the different categories of income chart of accounts you have defined in your books of account. So the chart of accounts is the first thing which you need to look at. Okay, so to see whether you have other income to an exempt income, dividend, interest, which are exempted or not exempted. Identify the expenses which are related to those exempted categories, because those exempted categories not any expenditure incurred for those exempted category cannot be deductible. And identify personal expenses. It's very important to identify when you are you're claiming your school fees of a children, how, to what extent you can claim it. You need to separate, or your fuel expenses, telephone bills, those are personal which cannot be claimed. Then you need to have asset capitalization, for because you have to claim a depreciation on those capitalized item, which has a, so we need to follow the IFRS accounting standard for the capitalization. Then interest expenses to be classified between third party and the land of the and the related parties, because related parties, interest amount which you are paying in, that is we need to see the substance for what it is being taken by the related parties. So that need to be categorized separately if you're taking from banks or related parties. Then entertainment expenditure, if you have seen that there's a limit to it, 50%. Then any penalties, donations, that also need to be recorded separately. That cannot be claimed, which can be claimed. And then the input VAT has to be, we need to start tracking even the small amount of input VAT to claim out of your output VAT. Otherwise, it will not be allowed as an expenditure to be claimed from business income. And the business paid by the owner to be accounted separately. Any expenses which they're paying as an owner, which can be claimed or not claimed, has to be tracked separately. Yeah, next slide. So now here the Balram will take over from this.
Yeah, so thank you, Manish, taking us through the various clauses and rules. Is it audible? Manish, it is fine.
Yes, yes.
So these are the areas where we have opportunity to plan our business structures. One of the such area is tax group. So companies, here we generally see the companies being formed, and some of them are formed by individuals separately, and some of them are formed by companies as a group. So let's look at some of the conditions that are required to form a tax group. Tax group can be formed by juridical resident persons, and it can be formed only by those group of entities which is owned by a holding company, and that holding company is investing in various subsidiary companies, and the holding company should minimum have 95% or more of ownership in those subsidiary companies. Only then they can form a tax group, including the subsidiaries and the holding company. So it's not only 95% of the ownership interest, but they also should have the voting rights or profit share right. And also if there is any distribution of the properties or assets of the company at the end of whenever he close that subsidiary. So they should have the right to receive that 95% portion from that net assets at the time of liquidation also. So if you have those rights, and you can form a tax group by clubbing those subsidiaries with the holding company. So, but you cannot have any parent company or subsidiary company which is falling under exempted category, which Manish explained. At the same time, you cannot have a qualifying free zone person as part of your tax group. Neither it can be a parent nor a subsidiary company. So, which means these exempted category companies as well as free zone persons or free zone companies cannot be part of your group. So, they should be kept independent and they should be separate. We'll look into this qualifying free zone definition in a little while. But if your free zone is not falling under the definition or falling under the category of qualifying free zone person, though it is a free zone company, you can still form a part of group as long as that free zone company is not been considered as a qualifying free zone person. And needless to say that the subsidiaries and as well as parent company should follow the same financials here, as well as the financials should be prepared by following the same accounting standards. So as you know, most of the companies here generally follow IFRS. I believe that is something that is allowed by corporate tax also to be followed. So what is the effect of having tax group? So now we've decided what are the conditions to form a tax group, but what is the impact? What is the effect of having the tax group? So when you form a tax group, all the entities within that particular group will be considered as only single taxable person. So which means you will be filing one return, you'll be having one registration, and only the parent company will be considered as an entity which is coordinating with the subsidiaries and combining the results of those subsidiaries and consolidating the financial statements and submitting these results as part of the tax return filed singly. But at the same time, the subsidiaries as well as parent are jointly and severally liable for compliance with the law as well as payment of the corporate tax liability. And this parent company can be replaced by any other subsidiary company by changing the structure as well as by applying to the FTA. So in this, I just want to clarify one important thing here is that in UAE, most of the groups, even some of the bigger groups also, there the corporate structure is not in the way that we discussed in tax group requirements. Mostly what happens is that the head of the family generally owns these different entities in his own name, or he includes some of his family members as the shareholders along with him in different entities, and then they run them. So those kind of entities, or if you have that kind of structure, so then you cannot form a tax group by combining those entities. So if at all, if you have to form a tax group and get the benefit of this tax group, so you have to change the structure and bring all those entities under the umbrella of one holding company and then form the tax group. So one important thing here is here to look at is that when you have a tax group, as Manish mentioned, the tax rates are going to be like 0% up to the tax profits of or taxable income of 375,000 dirhams and 9% in excess of that. So this is applicable for each taxable person. So you may have a doubt, like if you have four entities as part of the tax group. So do I get the benefit of this 0% up to 375,000 four times, or is it going to be only one time for the whole group as one? So here the answer is that it is only one time that you will get a benefit of it. So which means for the whole group, for all those four entities together, you will have 0% tax on 375,000 dirhams and 9% in excess of that. So you need to look at this also whenever you plan to form a tax group. Are you going to be benefiting out of forming the tax group? Or is it beneficial to have the entities or some of the entities out of the tax group and form the tax group with other entities? So you need to look at all these things. So we are planning this as or by complying with these rules. But at the same time, you're trying to get maximum benefit out of the planning. So tax reliefs, this is a common rule that is applicable in most of the countries or available or given benefit in most of the countries to the taxable persons. We are paying tax on the profits. But what if the company is incurring losses? Do we get any benefit out of it? Of course, the government or FTA will not give you any tax on that as back, but you will be allowed to carry forward this loss to the next year and adjust or offset this loss against the profit of the next year. So that rule is given, or that facility is given. But there is a limit given to that. So to what extent can you adjust these losses in future periods? So when you carry forward the loss, whenever you are setting up or offsetting the losses in that future year, only 75% of that particular future year profit will be available to offset the loss. We will look into an example to understand it more. And other conditions are like, since now we are transitioning into corporate tax regime, you may have losses for the period before this corporate tax period. So you may have a question, can I claim those losses also and carry forward, can I carry forward those losses also into future period and then adjust them against the profits of future period? So the answer is no, you cannot do that. The losses carry forward can only be, is only available for the years commencing on or after this corporate tax applicable to you, or on or after when you become a taxable person to comply with the tax rules. Not only that, if you have any losses arising from any asset or activity that is falling under exempt category, those losses also cannot be carried forward and offset against the profits of other taxable entities. So that is one important thing that we need to look at. There are certain other conditions to comply with, like, whenever you incur loss, the ownership is, whatever ownership you have, the same ownership should be continued in the year when you are offsetting the losses against the profits. If you're unable to do that, at least 50% of the ownership should be same in both the years when you have loss and in the year when you are offsetting the loss against the profit. If that is also not possible, you need to make sure that the entity is at least performing the same business or similar business in both the years, in the year in which you incur the loss, as well as in the year when you are adjusting or offsetting the losses and as the profits. So this is the example that I was referring to. Let us say that a company has got losses of 225,000 in 2024. So 24 is the year when the tax, a corporate tax is applicable to that entity. So obviously you'll not be paying tax on that. The entire amount of 225,000 will be carried over to the next year, which is 25. So let's say that in 2025, you have income or taxable profit of a taxable income of 100,000 dirhams. As I mentioned, not entire amount of 2025 on entire profit of 2025 is available to adjust against or offset against the losses. Only 75% of this 2025 year is available to offset the loss of previous years. So 75% of 100,000 profit of 2025 comes to 75,000. Though you have a profit of 100,000, the losses can be offset only to the extent of 75,000. So that is a limit that is given. So you had a 225,000 losses carried over from previous year, but we have 75,000 as a profit available to offset the losses. After adjusting this 75,000, you still have 150,000 left out to carry forward for the following years. So here, if you observe, in 2025, you had a profit of 100,000 and you did offset of previous year losses to the extent of 75,000, and you're left out with 25,000 profits, which are considered for taxation. Okay, so this is what, so which means in any given year, you're offering 25% as minimum of your profits to computation of the tax in that year, if you have losses in previous years to offset. Of course, if the losses are much lesser than your profits, then only those losses will be offset and then balance amount in total will be taxable. That's what you have to look at. And another important point that we need to note is that, as we have seen in previous slides, for interest carry forward, there's a limit given of 10 years. So you can carry forward and offset the interest only to the extent of next 10 years. But whereas in the case of losses, you can carry forward these losses to n number of years. So if you are incurring losses continuously, maybe if you are in the initial stage of your business, or if your business is such that you have a long gestation period to establish or to commence your commercial operations, so you may have losses for those years. Then these losses can be carried forward and offset in any n number of years in future. There is no limit for carry forward of your losses. So we have seen the losses of the same entity to adjust against future period profits. Now here, the another concept of transfer of tax losses between taxable persons means a loss of a company can be adjusted against profit of another company. So there are certain conditions to be met, but it is going to be offset in the same year. So both the entities should be juridical persons and they should be local persons or resident persons here, which means it cannot be adjusted against a profits or losses of foreign entities, though they may comply with the following other conditions. So both the entities should be local persons and they should be juridical persons. The other condition is that you need to have common shareholding of 75% in these two companies. So it could be company A is having 75% investment in company B, or vice versa, or it could be company X, which is having 75% ownership in company A and B. So in this case, company A losses can be offset against company B's profits, or vice versa. You may have one individual and he is owning 75% or more of company A and 75% or more of company B. In these cases also, company A and company B are eligible to offset their profit or losses against each other. So this ownership can be a direct ownership or indirect ownership through other subsidiaries. Okay, so this is what is second conditions to meet this or to get the benefit of this. And similar rules that none of the entities in this qualifying group can be an exempted corporation or entity, and none of this can be a qualifying reason person. So if you have any exempted company, exempt category company, you cannot offset the losses of that against the profits of other taxable persons, though you meet the other conditions. And same rule is applicable for qualifying reason person also. And needless to say that both the companies should follow the same financial year and they should prepare the financial statements by following the same accounting standards. Here also we have the same condition of or limit of 75% that we have seen in the previous slides. So we'll look into one small example just to understand it in detail. As I mentioned, company A and company B, let's say that these two companies are falling in that, meeting those conditions that we have seen in the previous slide. Company A has 2 million revenue and they have deductible expenses of 2,550,000 dirhams in particular year, and they have a loss of 550,000 in that year. And let's say company B has got 3 million dirhams revenue and they have deductible expenses of 2.4 million. So they are left with 600,000 as taxable income. As I mentioned, these two companies are falling in that qualifying group definition, and they can offset the losses against the profits of each other. So you have a loss of 550,000 for company A, and you have a profit of 600,000 for company B. But though you have 600,000 profits for company B, since there is a limit of 75%, which is available to offset the loss of other company, so 75% of 600,000 comes to 450,000. So which means only 450,000 is available to offset the losses of company A. So 550 was the loss, is the loss. And if you adjust 450,000 as offset of losses, so company B is still left out with another 150,000 profit, which is subject to tax. Now for company A, 550,000 was the loss, against which 450,000 is adjusted against the profit of company B. So company A is still left out with 100,000 loss, which is not offset yet. So this can be carried over to the following years and can be adjusted against the company B's profit if they still meet those conditions, or against the profit of its own company A in following years. So now let's look at other important rules related to corporate tax. There is something called withholding tax. So if you're dealing with any companies which are in countries where the corporate tax is already there, you may be familiar with this term withholding tax. So even this withholding tax is going to be implemented even in UAE as well. As of now, the withholding tax mentioned is at 0%. So what is withholding tax? Withholding tax is something that we as taxable persons in UAE are expected to deduct this withholding tax if a foreign company is doing any transaction with us, or they are providing any services to us, or they are supplying any goods to us. If they are not registered here, then we are expected to deduct the withholding tax on that particular transaction and pay the net amount to that particular foreign supplier. So whatever withholding tax that we deduct here, we are expected to pay this amount to the government, maybe as part of through our corporate tax return, or a separate return may come, a separate filing may have to be done for this. As I mentioned, at the moment, the withholding tax in UAE is 0%, which means you will not be deducting any withholding tax for now for the transaction that you do with foreign entities if they supply anything to you in the form of services or goods. But in future, they may increase this percent from 0% to some X%. So in which case you are expected to deduct that amount of withholding tax and pay net amount to them. If any company which is outside UAE, if they are subjected to this withholding tax and later they become taxable persons here, which means they are subject to corporate tax in UAE, though they are foreign entities, maybe through PE or through some other condition, then whatever withholding tax that was already being deducted against their transactions in UAE, that amount is available to adjust against the taxable or corporate tax payable within UAE for that particular company. So if the non-resident company, if it becomes a resident person here, or if it becomes a taxable person here, in that particular year, if they've already paid some withholding tax against any other transaction, this withholding tax is available to offset against the corporate tax payable and then pay net amount to the government. So this is a rare case which may not be applicable for most of the companies in general. So foreign tax credit, it is similar to withholding tax, but there is a slight difference here. You as a UAE entity, you have a foreign branch or you have a subsidiary in foreign country. Since it is a branch which is operational in outside UAE, so it may be subject to tax in outside UAE as well. So you are paying some tax outside UAE on the profits of the branch or a subsidiary. Now, if that is a branch, and in general, any branches are considered as part of the parent or head office by default under UAE corporate tax law. So since it is branch of yours, which is established outside UAE, when you compute your taxes for the company in UAE, so you are expected to include the income of that particular foreign branch here and then compute the taxation. So since you already paid some tax on the profits of your foreign branch, and here also you're including it, so there is a double taxation here. You are paying tax there as well as you're considering the tax here in UAE as well on that particular foreign branch income. So now you are given a credit or a benefit of credit that if you pay tax outside UAE on your income of branch, and if that particular tax rate outside UAE is more than 9%, then that tax that you paid outside UAE can be claimed as a credit. After computation of the tax on full amount of your income here, you will take a credit of the tax paid already, and then you will be paying only net amount to the government here. Let's say if the foreign tax that you paid is less than 9%, then that lesser amount what you paid will be available to you as a credit, and then pay the net amount in UAE to the government. So let us quickly look at one small example. Let's say that you have a revenue of 3 million and you have a deductible expense of 2.2 million, and then you're left with 800,000 as taxable income, on which you are paying tax at 9% in excess of 375,000 dirhams. So 800,000 minus 375,000 dirhams, which comes to 425,000 dirhams. On that you're paying 9%, which comes to 38,250. Let's say that you have paid a foreign tax on your branch income of 10,000 dirhams. And the tax rate applicable is 5% on that. It's only like in Bermuda somewhere you have this rate of 9%. So since you paid 10,000 on your profits of your branch, so this 38,250, which is computed for your whole parent company as well as branch income. So from that 38,250, you are eligible to claim or adjust 10,000 as a foreign tax credit, and then pay net amount of 28,250 to the government. So this is what it means. So this is one of the important, most relevant role for most of the companies or businesses in UAE, the free zones. Most of the companies, they operate by having the free zones here. They may also have entities in business in mainland as well as in free zones or whatever. But there are certain conditions to be met to consider your business or your company in free zone as a qualifying free zone person. So those conditions are like, the first and foremost thing is to maintain the adequate substance in the state, which means in UAE. So you have an entity in free zone, and you're saying that you are making a business of $100 million, $100 million, or 100 million dirhams in a year. Now, when they mention that adequate substance means you have to have enough substance to be able to perform that size of business. So what is adequate substance is not defined here. But if you take the similar definition that is given in economic substance regulation in UAE, so that speaks about having the adequate substance in terms of the employees here to conduct that size of business, having the management sitting here to take the strategic decisions and day-to-day operation related decisions here, having the enough amount of space of office space as well as storage space if it is required in UAE to the size of your $100 million or 100 million dirhams business, and also incurring operating expenses here in UAE to the size of your business. So as long as you are able to maintain that amount of substance in UAE in terms of this employees, offices, management, expenses, and whatever, then you are considered as meeting the condition of qualifying prison person. So they clearly mentioned that this adequate substance should be maintained in the state. So it's not required that you have to have this adequate substance in that particular free zone itself. So you can have in the free zone or in the state means it includes mainland also. That's what I understand from this. On top of that, you are also expected to maintain this arm's length principles if you have any related party transactions or connected persons payments, and comply with the TP requirements, transfer pricing requirements. So that we will look at brief in the following slides. So what do you mean by arm's length pricing or principles, and what are the TP requirements? And there is so this is second condition. Third condition is that you as a free zone company can elect to be subject to full taxation as if it is a mainland company. So you don't want to get the benefit of this 0% tax, but you want to choose to be considered as a mainland entity, though you're a free zone company, and you want your free zone company to be subject to tax at 0% or 9%, like any other mainland company. So if you want to elect, you can elect so. But if you elect that particular option, so you will no more be considered as a qualifying free zone person. So that is the third condition. And fourth condition, and most important and most awaiting condition, is that you have to derive qualifying income. So what is the meaning of qualifying income, or what is the definition of qualifying income? That is not out yet. We are waiting for the either cabinet decision or ministerial decision on this. So once that definition is out, so then we'll have more clarity on what is the income that will be taxed at 0% and what is the other income that will be taxed at 9%. Then you can also plan your things accordingly. So these are the four conditions that are mentioned by the ministry as of now. If they mention or come up with any other condition, then we are expected to comply with those conditions. Though there is no definition given for the qualifying income, but in the public consultation document, which was released earlier, in that they mentioned that if you have any business income coming from the free zones or from outside UAE, so that may be considered as a qualifying income. And if you have business from mainland entities, so that may not be considered as qualifying income. So that is what is the understanding that we have from public consultation document. We don't know whether that will be the same even in the ministerial decision with respect to qualifying income or not. We have to wait and see. There is one more thing called global minimum tax. This is going to be applicable for the entities which are part of a MNE, a multinational entity, which has got a revenue of 750 million euros or more as a group revenue. For them, the higher tax rate, which is at 15% effective tax rate, may be applicable for them. So this will be applicable irrespective whether you're in free zone or in mainland. So that's what is expected to be applicable for them. As of now, this is not in place. So until the OECD comes up with this implementation date and UAE agrees to that particular date, then from then onwards, the entities which are falling in that particular group will be subject to tax at higher rate of 15%. So we have already seen what are the rates applicable to the free zone entities. If you are a qualifying free zone person and 0% is a corporate tax on your qualifying income, 9% is a taxable income or non-qualifying income. So as you mentioned, in the case of mainland entities, we have 0% on taxable income up to 375,000 dirhams and 9% in excess of that. So you have that benefit of 375,000 dirhams of it. But whereas in the case of qualifying free zone person, if you have non-qualifying income, this 9% will be applicable straight on full amount. You don't have the benefit of this 375,000 dirhams, 0% tax and all those things won't be given to you. So that is the reason it is very important for us to plan whether you want to be considered as a qualifying free zone person and then will be subject to tax at 0%. Or if you're not able to meet the conditions, do you want your free zone person to be considered as a mainland entity and be subject to tax at 0% up to 375,000 profit and 9% in excess of that? So there is another important provision given for small businesses. In decree law, they did not mention about the turnover, but afterwards they have released a ministerial decision on this. Any business which has got a revenue of 3 million dirhams or less in any particular taxable tax period, they can opt for this small business relief starting from the first year whenever it is applicable to you. But here, one of the condition is that one of the limitations that they've given is that this small business relief is going to be available up to 31st December 2026. Are they going to extend further, or do they have a different threshold given? That we have to wait and see. But as of now, the small business relief for the entities which have got revenue of less than 3 million dirhams in a year is going to be applicable until 31st December 2026. And not only that, within these 3 years, for example, let us say that in year 1 you have 3 million dirhams, but in year 2 you have 4 million dirhams. In first year you can apply or opt for the small business relief, and then you will not be paying any tax on that, your whole business income. But in year 2, since you have 4 million dirhams, then you will not be eligible to claim the small business relief. Let's say in year 3 you have only 2 million revenue. In this case, though your year 3 revenue is less than 3 million dirhams, since in year 2 you had a revenue which is more than this 3 million, so in second year as well as subsequent years, year 3 also, you will not be eligible to claim this small business relief. So until the time you do not exceed 3 million dirhams in any years, you can claim this benefit. Once you cross this threshold of 3 million dirhams, so in that year as well as subsequent years, you will not be eligible to claim any small business relief. So that is one condition that you have to look at. So which means all the years you need to have turnover less than 3 million dirhams to be able to apply for the small business relief. So the impact or the benefit of opting for the small business relief is that the taxable income of that particular business is considered as nil, which means you will not be paying any tax on that entire profit. The other impact of the small business relief option opting is that if you have an exempt income, so you will not have that exempt income related rules applicable to you. And of course, if you have any deductions of your expenses and all those things, those deductions will no more be, or rules related to those deductions no more be applicable to you in that particular year. In addition to that, the transfer price and documentation and all those things, you need not to comply with them in that particular year. And if you are falling part of in the group of qualifying group, and the benefit of transferring the losses between those group entities also will not be available. At the same time, the losses incurred in those years is not available to carry forward for the future years to offset against the profits. So here the basic thing is that if a company is having losses, you may or may not opt for the small business relief, though your turnover is less than 3 million dirhams, because you are losing the benefit of this tax relief carry forward if you have any losses. So most of the companies which has got profit and their revenue is less than 3 million dirhams, they can go for the small business relief option and then enjoy the benefit of that nil tax. So these are some of the key takeaways out of the slides that we went through. You need to record the withholding tax paid. So far, we have not recorded those withholding tax paid. For example, let us say that you have a customer in Oman and you are providing some service to them. Since corporate tax is already applicable in Oman, so they are expected to deduct withholding tax on the transaction value and then pay net amount to you. Let's say you are making a transaction of 100,000 dirhams. On this 100,000 dirhams, the tax withholding tax in Oman is 10%, so they will be deducting 10,000 dirhams on this 100,000 and pay net amount of 90,000 to you. So for this 10,000 that you lost as withholding tax was a loss to you or expense to you. But after corporate tax coming into place, this 10,000 you may get a tax credit as we have seen, and then adjust against your tax payable amount here, as long as you meet other conditions. Which means you have to maintain separate track of this or account for these transactions of withholding tax, and then take the benefit of tax credit at the end of the year. So now you need to look at the books of accounts and then have a separate account for this. Not only this, even your records for your foreign entities which are subject to tax in UAE as well as outside UAE, you have to maintain them properly and then make sure that they are included here. You have to perform the cost benefit analysis between free zone entities and mainland entities, whether you want to be elected as a free zone qualifying free zone person and then be subject to the 0% tax there, or do you want to elect to be subject to tax at mainland entities rates, though you are a free zone entities? That planning you have to do. You also need to look at small business relief and see whether you want to include that particular entity as part of your tax group or not. Or do you want to include that particular entity as tax group only after expiry of these 3 years of small business relief given? So you have to look at all these things. Related party transactions. This is one of the important area as well as a vast subject to cover in this session. But we will try to touch base on this quickly and to see what are the related parties and then what is the basic documentation that is expected. If you need more details on this, we may have to plan a separate session only for transfer pricing and related party transaction related thing, which we may plan to do it in future. Not only this, we have separate arm which is looking primarily into this. If any of you are looking for additional support or service on this related party transactions and transfer pricing things, we can provide these services. So let's quickly look at what is related party. So a natural person who is having investments in a juridical person in a company and that ownership is more than 50%, then these two natural person and juridical person are considered as related parties. So not only through ownership, even if that individual is controlling that entity, and then in that case also this natural person is considered as related party to the company. Not just individual person and then juridical person, even within the juridical person also, if company A owns 50% or more ownership in company B, then company A and company B will be called as related persons. Or company A is investing 50% or more in company B, as well as 50% or more in company C. Then these three companies together will be considered as related parties. Or company A is controlling company B and company C. Then also these companies will be considered as related parties. So this investment can be through direct investment or indirect investment. So in any of these situations, all these entities will be considered as related parties. There's a concept called connected persons also, which is not prevalent in many other corporate taxes in other countries. But here, since we do not have individual taxation, so they came up with this concept called connected persons. So this is going to be for the individuals or natural persons who are owners of the companies, not only owners, but their relatives as well as directors and other officers who are in responsible position, plus their related parties, or relatives also. So owners and their relatives, directors and the relatives of the director, or officers and their relatives. So all these people will be considered as connected persons for a company. When we say relatives, what kind of relatives? So they said that up to fourth degree of kinship of these owners, directors, and officers will be considered as relatives, and they will fall under the definition of connected persons. So fourth degree of kinship means 4 generations above and 4 generations below. All these people will be falling under this particular definition of related parties. So why is it relevant? Why do we have to talk about this related party transactions or connected persons transactions? So the basic idea is that when you are a related party, whenever you are conducting any business with them, there's a possibility that the rates that you do charge for those transactions may not be at market rate for whatever reason it could be. So they may be at cost, they may be at cost plus some margin, or whatever it is. So the only thing is that you may or may not be selling those or doing that business with your related parties at market rate. So now corporate tax or corporate tax law wants you to make sure that those transactions that you deal with or do with your related parties are at arm's length. They are at market price, so that there is no room for you to play around and then minimize or reduce or avoid the corporate tax. So this is mainly to avoid having tax leakage. So you are expected to comply with this documentation. You are expected to demonstrate that any transaction that you do with your related party or connected persons is at arm's length and that is at market rate. Okay. There are various methods under which you can demonstrate or you have this benchmarking done. It varies from your transaction, industry, and arrangement. And there are different situations which will influence your decision to use the method. The methods are given here, like 6 methods: comparable and controlled price method, resale price method, cost plus method, transaction net margin method, transaction profit split method, other methods, if there is any. So these are the methods by using which you have to demonstrate that your transaction with related parties are at arm's length and you're complying with the TP documentation as well. So you may have a doubt, like, what are the transactions that may generally fall under these related party transactions? There could be services like IT, ITES. You may have IT company, IT providing company in India, and this Indian IT company or the service providing company can provide services to companies of your group in UAE, in USA, or elsewhere. So whenever you have transaction with this particular IT company in UAE, with a company in UAE, since these both are falling under the definition of your related parties, so you need to make sure that any transaction that you do is complying with this related party and TP documentation, and the transactions are dealt with at market price or at arm's length. Not only for services, even for goods also, purchase and sale of goods between these related parties. And you may transfer tangible properties from one company to another company, or you may use or lease out the properties from one company to another. You have to look at the lease amount that you charge onto them or the transfer price that you do for transfer of the properties. Financial agreements may be intra-group loans or guarantees given. So how much are you charging as interest on them? Is it at arm's length or not? That's what you have to look at. Intangible properties like in IP, you may have a company in BVI which is owning IP or trademark, and that BVI company may be charging some royalty or some other fees to other group companies. Then you have to make sure that this royalty or other charges that is there is done at arm's length. Capital transactions could also be there, so you have to make sure that they are at arm's length and TP documentation is complied with them. So the other group transactions could be like cost contribution arrangements, domestic transactions like you may have free zone entity and you may also have a mainland entity. Though you're not forming a tax group because it is not eligible to form a tax group, but you may have transactions between this mainland entity and free zone entity, and if the ownership is common and that is complying or meeting the definition of related party, then you have to look at this transaction that you do with mainland and in free zone, make sure that it is at arm's length. You may have business restructuring and other things. So with respect to connected persons, like owners, directors, and other officers and their relatives, you may have a number of payments between company and these connected persons. So some of the payments could be like salaries. So the owner can take salary, or directors may get salary from company, or the owner may have a property which is rented to the company of his own. So then he may be charging rent in the books of accounts and it is paid to the owner. Or you may have some perquisites or some interest on loan that is given by the owner or directors to the company, or any other payment that is done to these connected persons of owners, directors, or officers. All these transactions will be falling under the definition of this transactions with CP. And for all of them, you have to comply with the documentation that is expected. So you need to make sure that they are at arm's length and they're not paid more or they're not paid less. So this is a challenging area for most of the accountants to make sure that the salaries are paid at arm's length. When we say arm's length, what does it mean? So it means that if the owner is managing the company, whatever service he is providing to that particular company, if the same service is provided by a third party or an employee who is not related to the company, would you pay the same amount of salary? Or what amount of salary would you pay to them? So that is what is generally considered as arm's length or market amount, market value amount. Now you have to see whether you are paying the same amount of salary to the owner or not, or are you paying more than that? If you're paying more than that, then you have to adjust that excess amount and then add it back when you compute the taxation. That's what is the basic concept. Now let's get into the last leg of the session, like CT administration. When do you have to register yourself? Like Manish mentioned, you have to register before you file your first return. Of course, there are certain other entities which are expected to register themselves before, but any other companies, they are expected to register before they file the first return. It will be online registration, which is already available for most of the entities. They can go and register. So the same Imara tax is the one which you have to use for corporate tax as well. It is done online. And who all should be registered? Every company which is a taxable person, irrespective of your threshold amount or your revenue, you are expected to register. Even though you have losses, you are expected to register and comply with the requirements. Returns have to be filed online, and you are given a 9 months period after the end of the financial year. You have seen the table there, and there are no advance tax to be paid, no quarterly tax returns to be filed. So it is one corporate tax return which will be filed at the end of the financial year for one return for the financial year, which will have to be filed within 9 months from the end of the financial year. So this is how the corporate tax return could look like. We have prepared this based on the decree law provisions, or you may have some additional fields also, but this is how it could be. So for this, the basis is going to be your profit as a books of accounts. So you will have to consider the profits as per your books of accounts as the base. So this profit is prepared by complying with the IFRS requirements, International Financial Reporting Standards, or any other standard which is internationally accepted. And by taking that as the basis, you will make adjustments to them in order to come to or arrive to the taxable income. You will have to adjust certain expenses which are not allowed to be deducted. You have to make certain adjustments if you have any intra-group transactions or unrealized gains or losses or other adjustments. Then you will be arriving to the taxable income. On that taxable income, you will compute the tax to be paid or tax payable amount. To that tax payable amount, you will be adjusting if you have any withholding tax that you paid outside UAE or any foreign tax that you paid as a credit. Or if you have any other reliefs, then those reliefs will be adjusted, tax loss relief or any other thing. Then finally, you'll be arriving to the tax payable amount. So how long do you have to keep your books of accounts? They mentioned it is 7 years after the end of the financial year, which means effectively you have to keep all your records for a minimum of 8 years. And even exempt persons also are expected to keep those records. Other question is that, do you have to have audit report? And are you expected to submit your audit report along with the corporate tax return? Recently, they came up with a decision on this. So for mainland entities, any company which has got 50 million dirhams or more of revenue, they are expected to have audited financial statements and they should submit this along with the corporate tax return. And all the qualifying prison persons are also expected to have audited financial statements for each of the years. The other entities which are not falling in these two categories, they may continue to have audit reports, and it gives more comfort for you also to have audit of your books done so that you are not missing out on complying with this corporate tax. And at least your books of accounts are compliant with the IFRS, and then whatever computation that you do are at least in line with the expectation of the corporate tax. There are certain transitional rules because you had a period where there was not corporate tax applicable. Now you're getting into a period where corporate tax is applicable. So what about the transitional periods that rules that you have when you transition into corporate tax period? So they mentioned that the opening balances that you have should be reviewed properly, and they should be as if you have complied with corporate tax already, mainly with respect to your transfer pricing or related party transactions. If you have any balances which you are carrying forward them to the next year of first year of your corporate tax law applicability, then you are expected to comply with those transfer pricing requirements, make sure that these closing balance of this year are as if they have been already complied with TP rules, and then you are getting into the corporate tax period with adjusted amounts. Not only this, you have to review your books of accounts of current year and make sure that all your balances in your balance sheet are clean. There are no adjustments to be done with related respect to your previous years. And suddenly you will realize in next year when you get into corporate tax period that, oh, this should have been already adjusted. If you adjust that now, will I have to pay more tax on that particular adjustment or not? So that kind of circumstances could be there. So you need to look at the books of accounts now carefully and make sure that your books of accounts are clean. There is a concept called GAR, General Anti-Abusive Rules. Because the corporate tax law, decree law, is already been released, any arrangement or transaction that you do or changes in your structure that you do with the sole objective of reducing the tax or avoiding the tax, then those arrangements or transactions will be considered as no more prevalent. And whatever is the tax impact if that arrangement or transaction was not being done on your tax, so the same tax will be or same arrangement or taxation will be applicable to them if FTA want to implement that rule for you. So which means if you are changing any corporate structure or any other changes to your business structure, so you need to make sure that there is a commercial substance supporting that particular change or structure change. In addition to your tax benefit, of course, you may have tax benefit, but you also need to have a commercial reason, a valid commercial reason to support your change in the structure or changing in your business plans or organization on business structures. This is what is very important for you to look at whenever you go for any tax planning now. So this is how the assessment can be done. Like, high level impact assessment can be done if you engage us for your corporate tax assessment and implementation. And then later on, we can do the detailed analysis based on the high level impact assessment once you're comfortable with high level impact assessment. Then, of course, we will get into the corporate tax implementation by getting down to your transactions, businesses, and all those things. And once it is done, once the implementation once we got into the corporate tax period, we will look at the implementation and in post implementation, which is nothing but complying with your corporate tax returns and other requirements. Now that we have gone through the full, most of the important rules of the corporate tax law, let's look at some of the key areas where you have to focus now before you get into our corporate tax period and be prepared so that you are not having or not getting into any issues once you get into the corporate tax period. You need to review a corporate structure and make sure that you have a structure which is giving you maximum benefits from the point of view of tax. So we have seen what are the structural changes that you need to look at. Also look at whether you have free zone entity or do you have to have business in free zone or of mainland, or do you have to realign your business structure between mainland and free zone. Of course, you have to have commercial substance attaching to that change. You need to look at the standalone entities or group entities. Do you have to include a particular entity in a group or do you have to keep them outside of the tax group? That also you have to look at. If you have any related party transactions, you need to look at them and then make sure that you have documentation in place as well as your related party transactions are at arm's length. If you have to get into any adjustments to them, you make sure that you have benchmarking done to them and then documentation is maintained. And then when you get into the corporate tax period, you are already prepared with this. Do you have any exempted income? Then make sure that that is accounted separately so that when you file your corporate tax return, that is excluded from computation. And you also need to look at the impact of this corporate tax on your cash flow, profits, and net equity. Do you have to look at your pricing of your services or goods in order to absorb this corporate tax burden? And you also need to look at the chart of accounts, whether do you have sufficient amount of accounts to be able to handle the corporate tax requirements. For example, your entertainment expenses. Now that we know that only 50% of that entertainment expenses falling into that category will be allowed. Unless you have separate account to account these transactions, you will not be able to do it when you get into the city returns, right? Not only this, interest payments, you have to account separately. If you have any fines or penalties, you have to account them separately. All those deductibles and non-deductibles, you have to maintain separate accounts for them so that when you compute taxable income, you have clear amount to adjust. All the transactions and all the legal arrangements and contracts that you have with your customers and suppliers, you look at them and see if you have to have any amendments to them in order to comply with corporate tax laws. And not only you, if you want your team to be prepared, and if there's any training requirement, we can conduct any training for your whole team in specific. And some of the entities, they are also preferring to have mock assessments done for the years 2021, 2022, maybe for 2023 going forward, so that they will understand what are the issues that they have, where do they have to focus, and what is the impact of corporate tax in their books, cash flow, business, and what kind of changes or structures will be more beneficial. So these all will be understood only when you perform mock assessments for your 21, 22 years or whatever. So this is what we wanted to cover as part of the session. And hope we believe that we have added some value to your understanding of the corporate tax law. We are open to answer any questions. If you have any questions, you can definitely ask them now. Or if you have any question later on, or you want to ask them later, you may call us on the number given on the slide, or you may reach out to us on info@spectrumaccounts.com by mail. We are open to answer your questions through that as well. And meanwhile, Manish, the areas where you covered, like permanent establishment, in that you mentioned that an agent who is an independent agent will be subject to tax on its own. But what if I have a real estate agent? I'm a foreign company, a non-resident person. I have a real estate agent in UAE, and he is helping me in finding out the properties for me for investment. So, do you consider that agent as a PE for me as a foreign entity, or not a PE for me?
See, in this scenario, if the most important point is being an independent, if he is serving multiple such clients and deciding and referring to his his clients in India or any other part of the world as independent, and he's not being controlled by the non-resident in UAE. I mean, not so. If he's a real estate agent, is identifying customers, I know, and referring to for investments in India or in Europe. So that ways he's supporting this non-resident, or it could be like a non-resident want to invest in UAE, and he's serving that in his independent capacity to different clients. Then he's an independent agent, and he would be taxed being a resident in UAE, not the non-resident being outside UAE.
I think there's a question in the chat box that is there any other way to register or log into the tax online portal than UAE Pass? Yeah, I think you can have a user ID password. Through that also you can access it. And to register, see, if a company is registered for VAT already, so those are the credentials that you have to use for corporate tax registration as well. Once you log into that Imara tax, on that you have a registration option given for corporate tax as well. And you can use those credentials, user ID password, to log in for corporate tax as well. Yes, so though you are logged in through UAE Pass, I think you are expected to have your own user ID password, which allows you to access your account through those user ID password in addition to your UAE Pass as well. The other day we had a few questions on the salaries to the owners and other payments to the owners. So this is one of the area where most of the companies, almost all the companies, will have issues with. So what is the salary which is considered as at market value or at arm's length? So this is the challenging part of it. So you need to consider various things in it, as I mentioned, how much amount you would pay if the same service is provided by an employee to the company, and to the same size of the company in the industry, in the same industry, how much is it paid in other entities. So you have to look at the industry benchmark. You have to look at the independent parties. If they provide the same service to the company, how much would you pay? Of course, you as a owner, you may take more risk. You may involve more than an employee. So you may have to include or add that extra amount towards the risk that you're taking or adding value to the business, you as a owner compared to the employee. So you have to look at various scenarios. So how much would you pay to an independent person if the same person is the same service is offered? How much is it paid in the industry of same size in the same region? In addition to that, you also need to look at your bottom line profit. How much percentage of profit or how much profit are you offering to the FTA as a taxable income? Is it in line with the tax that is offered, a percentage of the tax, a percentage of the profitability of the similar size entities in the same industry in the region? So you may have 15% as the net margin or net profit percentage in the industry, but you, in your company, you're only offering 5% as your net profit to the tax authority. So then there is a difference, right? So which may lead to your salary that you pay, other payments that you make to the owners, is it falling in place or not? So it's not just the amount that you pay to the owner and you come up with the benchmark for that amount, but it is also the profitability that you're offering to the company, to the authority. Is it in line with the industry's profitability or not? So is there any manipulation that is done through payments to the owners? So both these angles we have to look at and then arrive to the amount that is considered as a benchmark amount or arm's length amount to be paid to the owners.
Balram, just want to for the small business relief which we have, there is limit of 3 million. Though there is a limit, but then they need to still register for the corporate tax purpose. But then there was a concept of artificial, creating those different entities within the group. So can you enlighten more on that? How that company need to be careful of forming those small entities.
Yeah, I think so. So we have the small business relief for the companies with 3 million dirhams or less revenue. But in order to get the benefit of that, some businesses may plan to go for more than one entity create and then make sure that the revenue is falling below this threshold in each of these entities. So I think you need to be very careful if you are planning some things like this. There's a concept called GAR, General Anti-Abusive Rules, which I mentioned just now. So if it appears to be like you are forming these entities with the sole objective of avoiding the tax, then definitely if FTA comes to know that, they can combine all these as one entity and then apply this tax rules accordingly instead of giving the benefit of the small business relief. So you need to be very careful in doing this planning. Is your sole intention is to just minimize or reduce the tax or avoid the tax, or is there any other commercial reason to do that? So that's what is more important. So you should be in a position to demonstrate. Whenever FTA comes back to you with a question, you should be in a position to demonstrate the reason why you went to that particular arrangement. If FTA is satisfied with that, that's when you will get the benefit. Otherwise, it will be reversed and the entire amount will be considered as taxable amount. As if it is a single entity, then you'll be subject to tax. So what is the difference between small business relief of 3 million and CT threshold of 375,000 dirhams? I think it's a very important point, and it is important to look at it for most of the small companies whenever they want to go for the small business relief. So 375,000 dirhams threshold is given for all the entities which are subject to tax at regular taxation. So which means your taxable profit is subject to tax at 0% up to this 375,000 dirhams. And in excess of this 375,000 dirhams is subject to tax at 9%. But whereas the concept of small business relief is given to only those entities which have got 3 million dirhams or less, and in which case you will not be looking at this threshold and all those things. You are straight away, the entire amount of your company is considered as non-taxable. So tax to you is nil. Let us say that you have 2.5 million dirhams, and out of which you are making a profit of 700,000 dirhams. Okay, since your 2.5 million dirhams turnover is there, so you can go for the small business relief, correct? And then if you don't consider or if you don't opt for the small business relief, the 700,000 will be considered as a taxable income. And from 700,000, 375,000 will be removed and the balance amount will be subject to tax at 9%. So you'll end up in paying some 30,000 or 40,000 dirhams as tax if you don't opt for small business relief. But whereas since your turnover is 2.5 million, you're falling within this 3 million dirhams threshold, you can go for this small business relief, in which case this entire 700,000, which is taxable income or a profit for you, is not taxed at all. So you are saving this 38,000 or 40,000 amount of tax, as long as you are meeting the conditions of the small business relief. So that is the difference.
Just further to add on to this, this limit is on the revenue for a small business to be 3 million. And then this revenue has to be computed as per the accounting standard, IFRS. So that is more important, and where the FTA would look into your computation method of that revenue. And you need to apply and elect to be claiming as small business really. By default, you won't get, you have to apply to the FTA to get to claim the benefit of small business.
I think there's a request from our team that some of you have not shared the email. If you want the presentation to be shared, kindly share your email. You can share the mail here itself in the chat box, and then we will be able to send you the presentation through the mail. Do you expect, there's a question in the chat box, do you expect any personal income tax? I think it is very tricky to answer, but as of now, they also confirmed, the ministry also confirmed that they're not considering any personal income tax as of now. But you never know. So depending upon the situation, they may. But saying so, as I mentioned, the definition or the rules relating to the taxation on the incomes earned by the individuals, they are still going to come up with the rules. The rules related to that are not out yet. If you as an individual is conducting any business activity, though you are not having any trade license, then your business income is going to be subject to tax. Legality of it, whether it is legal to conduct the business or not, is a different issue to handle. But as long as you are conducting any business or activity which is commercial in nature, you're doing it on a repetitive basis or non-repetitive basis, but it is a commercial transaction that you're doing and it is in the form of business. Then whatever income you earn out of it will be subject to tax in your hands. So that is very important. All the sole establishments or unincorporated partnerships are civil companies. So all those will be, though they are entities, but they are not different from the individuals or owners. So all the incomes generated from these entities will be subject to tax in the hands of individuals, and they are expected to register and comply with this. And another important area is the real estate, investments in real estate by individuals here. So do you, whatever rent that you get out of that particular investments or capital gains that you earn out of it, is it going to be subject to tax? Will it be considered as a business income or not? So that is one of the very important area where the FTA or ministry is still yet to come out with the rules. But what I understand, what I assume is that if you are doing these activities on a regular basis and the investments whatever you have is it out of your own personal income that you're investing and then doing it, or is it out of your mobilization of funds from various sources and then you are investing it and then you are operating it in the model of a business, in which case it is in substance looking like a business, then that may be subject to tax. Or you have a huge amount of properties and you are given this to someone else to operate, so you are in substance, no, it is a commercial activity to you since you have a huge amount of investments. So it may attract corporate tax. But we need to wait and see what is the ministry is going to come up with. At the end of the day, it is a rule that they are going to come up with it, and we have to comply with that. So if there are no other questions, I think we will be ending this session. But as I mentioned, you can always reach out to us. Yeah. So once again, thank you all. So we can definitely provide you services on corporate tax, maybe in terms of assessment of corporate tax applicability to you and how do you have to be prepared to be able to handle corporate tax requirement. And then after getting into corporate tax period, how do you have to maintain your books of accounts and then how to file the corporate tax returns. In addition to this, we can also help on registration, as well as we have an extended arm which is which has expertise into transfer pricing and international taxation, maybe in terms of structuring, as well as complying with the documentation of transfer pricing, connected persons documentation and benchmarking. So we can definitely provide services to you and to your clients if you want. So we can do those services. So thank you very much for all of you to attend this session. And we will share the presentation for those email IDs which are available with us. And happy Sunday to you all.